Meeting to order. Pursuant to Standing Order 1082, subject matter of Bill 63, Second Act to implement certain provisions of the budget tabled in Parliament on March 22, 2017, and other measures. We have quite a number of sections to go through. Hopefully we get through them today, and we'll have witnesses from various departments and areas within the Finance Canada to explain the measures that are in the parts 1, 2, 3, 4, and 5 and other divisions in the bill. So we'll start with part 1, amendments to the Income Tax Act and to related legislation, and we have with us Trevor McGowan, who's the Senior Legislative Chief, Tax Legislative Division, Tax Policy Branch, and also from the Tax Policy Branch, Director of Personal Income Tax Division, Mr. LeBlanc, and Senior Tax Policy Officer, Mr. Frieda. So the floor is yours. I think you have an opening statement, and then we'll go to questions.
Thank you, Mr. Chair. I'm going to provide a brief overview of the items in Part 1 of the bill, each of which relates to income tax proposed amendments. The Part 1 includes a number of amendments that were announced as part of the 2017 federal budget. These include removing the classification as Canadian exploration expenses of costs incurred in respect of a drilling well. They would instead, unless they're proven to be unsuccessful, be classified as Canadian development expenses. If unsuccessful, they would continue to be Canadian exploration expenses. They would eliminate for qualifying small oil and gas companies the ability to re-characterize up to $1 million of exploration expenses as, of expenses that would otherwise qualify as Canadian development expenses as Canadian exploration expenses. The difference being that Canadian development expenses are deductible at a rate of 30% per year, whereas Canadian exploration expenses are fully deductible in the year incurred. They would revise the anti-avoidance rules for registered education savings plans and registered disabilities savings plans, aligning them with the current rules that apply in respect of registered retirement savings plans, registered retirement income funds, and tax-free savings accounts. They would eliminate the ability of designated professionals to use the billed basis accounting system, and they would instead be required to use the general rules applicable to other taxpayers in the Income Tax Act for their tax accounting purposes. They provide enhanced tax treatment in respect of eligible geothermal energy equipment. The enhanced treatment consists of accelerated capital cost allowance rates of, in Class 43.2, 50%, as well as the ability to classify certain expenses in respect of qualifying geothermal projects as Canadian renewable conservation expenses, which can be deducted in the year incurred or transferred to investors in flow-through shares. It extends the currently existing base erosion rules that apply to foreign affiliates of Canadian taxpayers and prevent them from inappropriately shifting income in respect of the insurance of Canadian risks offshore to a foreign affiliate. It would extend those rules to foreign branches of Canadian life insurers, which for many purposes of the tax system are treated in a manner similar to foreign affiliates of a Canadian corporation, including their, in very general terms, exemption from Canadian tax on their active business income. It would clarify who has factual or often called de facto control of a corporation for Canadian tax purposes. This is intended to return the state of the law to what it was before a recent court decision, and requires that all relevant factors are to be taken into consideration in determining whether a person has factual control of a corporation. It introduces an election that would allow taxpayers who hold eligible derivatives as income property to be able to treat them as mark-to-market properties, which would allow changes in the value of the derivatives to be realized for tax purposes on an annual basis. Otherwise, the default rule would be taxation on a realization basis. It introduces specific anti-avoidance rules in respect of so-called straddle transactions. These are transactions that use somewhat complex derivative instruments, offsetting derivative instruments to achieve an inappropriate deferral of taxation from one year to the next. It would allow mutual fund corporations that are organized as what were previously called switch corporations, but would now be more appropriately called multi-class mutual fund corporations, where each class of shares of the corporation is a separate investment fund. It would allow them to effectively, on a tax-deferred basis, merge or split up into a number of mutual fund trusts. So each of those mutual fund trusts would constitute its own investment fund. It would also extend or improve the tax treatment of segregated funds. These are insurance products that in many ways, including their tax treatment, are intended to be similar to ordinary investment funds, except there are some minor differences. This bill would extend the ability for segregated funds to merge on a tax-deferred basis and as such achieve economies of scale, and also would allow the carry forward of non-capital losses from one year to the next. Both of those can currently be achieved by an ordinary mutual fund operating through a trust, and so that would be extended to segregated funds of insurance companies. Lastly, for the budget measures announced in the budget, there are enhancements to the protections afforded to gifts of ecologically sensitive land. It also implements a number of other income tax measures in Part 1 by closing loopholes surrounding capital gains exemption on the sale of a principal residence. These were mentioned or released for public consultation in October of 2016 and were mentioned as previously announced measures in the budget text in the tax measures supplementary information. It extends a measure announced as part of Budget 2017 to provide additional authority for nurse practitioners who, for many Canadians, are their primary point of contact in the medical system, so that nurse practitioners can certify things for a number of purposes beyond the disability tax credit, which was announced in Budget 2016. It would also, following on a measure from Budget 2016, provide that sales by qualifying farmers or by farmers and fishers of their farming products and fishing catches to qualifying cooperatives would be exempted from the measures announced as part of Budget 2016 that would prohibit the multiplication of the small business deduction, allowing each such farmer or fisher to have full access to the small business deduction. It would also introduce a number of proposed technical amendments that were announced for public or released for public consultation in September of 2016 and were also mentioned in the tax measures supplementary information that accompanied the budget. These include measures that would extend the types of reverse takeover transactions to which the corporate acquisition of control rules apply, make a number of tweaks and improvements to the scientific research and experimental development rules. It would provide rules for the allocation of income for federal credit unions between provinces and territories that essentially or pretty much completely mirrors the rules that currently apply to banks. It would make a number of changes to improve the operation of Canada's international tax rules. And lastly, it would contains a number of measures that are technical in nature to improve the accuracy and consistency of the income tax legislation and regulations. These are technical amendments that are announced for consultation and included in bills from time to time that ensure the proper ongoing operation of the income tax system. And that's a summary of the measures in Part 1 of the bill.
Thank you, Mr. McGowan. The normal procedure for, I should have explained this in the beginning because there's a number of people that weren't on the Finance Committee before. We don't go with the normal rounds. If you got questions, just catch my eye and we'll go for it. And I see John McKay is here, former Parliamentary Secretary to Finance. There's a twinkle in his eye just to be back. Who wants to go first? You, Mr. Sabara.
Sure, thank you. Welcome, gentlemen. On the bill basis accounting, how will contingency fee arrangements and pro bono work be handled within your rules, please?
Thank you for your question. As I said in the introduction, the elimination of the election to use bill basis accounting would essentially align the tax treatment of the designated professionals. These are, as you mentioned, lawyers, but also accountants, dentists, medical doctors, veterinarians, and chiropractors, to the rules that are generally followed by most businesses and taxpayers. And so I would categorize those two separately for pro bono work that's not intended to be billed. Well, I guess I should explain the general rules. You can value inventory at the end of the year either at its fair market value or on an item of inventory by item inventory basis at the lower of cost and fair market value. So that's the choice that's available to taxpayers generally, and that's the default set of rules that are considered to provide the truest picture of a taxpayer's income. So for pro bono work that is not intended to be billed, it would have a fair market value of essentially nil, in that there's no intention to bill it. There's not going to be a recovery on that time, and so it would be valued at that for tax purposes. For contingency fees, the taxation is a little bit more complicated. There's case law and Canada Revenue Agency administrative guidance to the effect that even in the absence of Section 34, which provides the election for bill basis accounting, certain contingency fees where your return on your time is not guaranteed. A classic example might be whether or not you're going to get paid at the end of the day is determined by whether or not you win a court case or how much of an award is given in court, and there's real uncertainty as to whether or not that will be received. There's case law to the effect that in those situations, there's no ascertainable fair market value to the work in progress, and so it would not be taken into account for tax purposes. Otherwise, you have, for contingency fees, the requirement to come up with a reasonable estimate of what the fair market value is, and so you can tell what you think the value is, and if there's a complete contingency fee and you just have no idea, perhaps it's not taxable for being too uncertain. If it is sufficiently certain, then you can arrive at a reasonable fair market value. If after the end of the year, and that can take into account anticipated write-downs and fees and time that you don't think you're going to bill and so on. If after the end of the year you decide that, well, actually you were wrong, you can do a write-down of that value for tax purposes. And lastly, if you hadn't asked that, but I guess the next step is if you have bad or doubtful debts, there are reserves for those as well, so you're not immediately taxed on it.
Okay, thank you for that explanation, especially on contingency fees. Moving on to the small business deduction, I think in one of our prior budgets, we prudently, in pursuit of tax fairness, had removed the small business tax deduction, the multiplication of that. In this budget, we have a measure put in place, and I think rightly so, for farmer cooperatives, more so. And I wanted you to just, if you can clarify that and ensure that we all are aware that farmers and folks belonging to cooperatives will not be penalized.
Yes, of course, I would be happy to. I think it would be a good idea to provide a brief overview of the 2016 proposals. We have a small business deduction that allows qualifying small businesses on up to $500,000 of their active business income to get a, well, it is a small business deduction, but it's commonly thought of as just a low rate of tax, currently 10.5%, recently announced to be reduced down to 9% in October. In October, that was announced. So the general policy for the small business deduction is that you get one small business limit of $500,000 per business. And so tax planning that had arisen would, in a classic case for a partnership, have one business where each of the partners, let's say there's 10 partners, would normally have to share that business limit. So instead, each of the partners would incorporate a side company that would provide that partner's services to the partnership, thus multiplying access to the small business deduction by the number of partners. 10 in my example, bringing it from 500,000 to essentially 5 million. So but the Budget 2016 measure constrained that to provide that when there's one business, there's only going to be one business limit. That didn't just apply to partnerships, it also applied to central corporation structures, which could, in the corporate context, achieve the same multiplication results as you could have gotten in a partnership. But as part of our continuing consultation with stakeholders, we heard from a number of farmers and fishers who had dealings with cooperative organizations that really for cooperatives, they have membership interests in a cooperative, which are for many purposes, including for the purposes of the small business deduction in the tax system, they're treated like shares, but they're not fundamentally the same as shares, and they're different enough to be outside of the policy against the multiplication of the small business deduction. For example, they have often one vote per member, kind of regardless of the number of shares, whereas if you're a shareholder, you're voting. They can allow you to elect members of the board of directors, for example, is proportionate to the number of shares you have. Likewise, with a normal company, with your shareholdings representing more of an economic investment, you're looking to participate in the profits of the corporation, and your participation in the profits is going to be determined by your shareholdings. Whereas with membership interests in a cooperative, it's a different system. And so in these cases where you have farmers or fishers selling their farming products or fishing catches to a cooperative, those would be called specified, I think it's specified cooperative income, and excluded from the rules that prevent multiplication of the small business deduction.
Thank you, Chairman.
Mr. Albus.
Just on the very same topic. So last year, this time, we had BIA2. We had radiologists specifically that said that they worked in shared practices, and they were denied the small business preferential tax rate because they were billing as a collective, but they were dispersing it separately through, they were actually billing as one and receiving it. And the minister disallowed that in last year's legislation. So are you saying that if those self-same doctors who used to use shared practices were to form a cooperative, that they would be able to get access to the small business rate? And
I'm trying to remember exactly how the radiologists would have organized their structure. As I recall, many medical practitioners were organized in
shared practice.
Right, and the concern was that they were
each taking an individual one.
Right, that they were considered partnerships legally, and the rules apply to partnerships and central corporation structures. I don't know that they apply to, or they don't apply to true cooperative structures, that are not partnerships. So the concern, as I recall from 2016, was that for a lot of these structures, they would be characterized at law as partnerships. But if you don't have either a corporation carrying on a business with shareholders, if you don't have the corporation carrying on the central business or a partnership, and instead it's carried on separately by a number of people sort of cooperatively, then the rules wouldn't apply. They apply in respect to partnerships and central
So if they have a cooperative structure, then they would be able to have access to the small business deduction, even though there was a multitude of them working within that.
The difficulty is in...
Well, they'd each would get a share, though. That's what you're saying that's happening for farmers and fishers.
Well, I think part of the difficulty is in the terminology. If you have a cooperative, in this case, it's for the purposes of the tax rules, it would be treated as a corporation. For at least the small business deduction rules. But if you're talking more colloquially and not in the specific technical sense that you have in the tax rules, that they're carrying on, I shouldn't say carrying on business in common because that's the technical legal test for determining a partnership. But if you have a number of people operating through a joint venture or in a somewhat cooperative fashion, then that's a different thing. But as I recall, the concern from a lot of medical practices was that while they initially thought that they ought not to be considered partnerships for the purposes of the rules, they might be considered partnerships legally, and as such would be into the multiplication of the small business deduction rules that way, and not because they were legally organized as a corporate cooperative within the purposes of the small business deduction rules.
Okay, well, I'm going to take forward that if they had formed, instead of a shared practice, a cooperative, then in the same vein that they should receive the same equal treatment, because I hear that we're all about tax fairness in Canada, right? And so we have a whole bunch of people last year. The average, I think, was $40,000 that they were hit. There were some obviously hit much harder than others, and many of them faced a tax bill. And anyways, to me, it seems that this seems to be completely contrary, Mr. Chair, to what we heard last year. So anyway, I'd like to actually go back to the elimination of the use of billed basis accounting by designated professionals. First of all, quick question: in the summary, you listed as D of the bill.
Okay.
Okay. And yet it's the first provision in the bill. That doesn't seem to coincide. So maybe next year that might be a thing just to consider, just to make it easy for members of Parliament to walk through the summary. Now, in the Act, or the proposed Act here, it's called work in progress versus bill basis accounting in the summary. Are they the same thing?
Work in progress is your work that has been done up to a particular point, but that is not yet billed. And so bill basis accounting versus accrual accounting are two different ways of treating, for tax purposes, your work in progress. So your work in progress is a thing, and the question is, how is it to be taxed? The general rules provide for an accrual treatment, for accrual accounting. But this provision in the Act allowed designated professionals to elect into a billed basis method, which would change the tax treatment of how work in progress is taxed. So that's how they relate.
Okay, but you see how when you say one thing in a summary and then another thing in the actual Act, it can be a little bit confusing to the average person. So consistency is key, I think, just so we're all in the same. So when it comes to low-income individuals, say they end up in a car accident, ICBC in my province says we're not going to pay you for things. Happens all the time. So someone goes to a lawyer says, I'll represent you. It's not going to be for free, but if we have a winning case, I'll get a percentage of contingency. So how does this work in that case? Would they be paying tax about 20% per year on something that may never result in actually money coming in the door?
As I noted earlier, it depends on the specific facts, and probably a bit more detail in your case, but I can say that there is case law and CRA administrative guidance in support of the proposition if there's real uncertainty about the outcome of the case, and it's a contingency fee arrangement, that might, even absent the Section 34 bill basis accounting election, it might be excluded from your inventory for tax purposes, and so you wouldn't be taxed on it in the current year.
So when you mean inventory, you're talking about a service that's being delivered, correct?
That's right.
Okay, so you're equating inventory on a store shelf to a service of a lawyer.
That's right. Your work in progress, your performed but unbilled hours are treated for tax purposes essentially as inventory.
Okay, so if someone does a lot of work, doesn't get anything for it, shouldn't they be able to write that off? Because there are expenses all along the way, filing papers. That's something the lawyer receives absolutely no remuneration on. So are they going to be able to lower their tax burden, or is this expected to be only added on when they'll be paying more under this new section?
Right. In the abstract, you can elect to choose fair market value or the lower of cost and market method for valuing inventory, and so in the case where you have a lawyer, they've incurred expenses, costs in order to earn the revenue for this case. You can measure that file and the work in progress in respect to that file at the lower of its cost and fair market value. So if you had, I believe in your example, it was $10,000 of work in progress at the end of the year. I recall hearing 10,000, I might be mistaken, but let's say they have $10,000 in work in progress at the end of the year, and they've incurred $6,000 of costs, say they had an associate on the file and whatever is properly allocable to it, then it could be valued for tax purposes at the lower of your cost and fair market value. So your costs, which would be generally deductible, would offset your income from the work in progress. But that's just in a sort of abstract case.
Okay.
And I recognize you'll have more than one file, of course, in a practice, which brings to the second point that it represents essentially a deferral. If you can think of it in the simplest case, where you perform services in one year and then bill in the next, then you have and let's say to make the example simple, you have just that one item that's worth $10,000. So it's not under the bill basis system where you get it included in your inventory when you send out the bill. You could have the costs in the first year, but then you'd have an income inclusion in the second year where the first year's income was deferred to. So you will pick that up in the second year, and in that year, if you take on another file with a contingent amount to be paid after the end of the year, so it'll be billed out at the end of the year, then, and let's say that's of comparable size of, say, $10,000, then you wouldn't bill for that in the current year, your second year, you would bill it in the third year. So if you look at the tax results in the second year, you have $10,000 that have been deferred from the previous, and then $10,000 deferred into the next. So you can see that you end up in roughly the same place as if you had, at least in respect of that year, been taxed on an accrual basis. And so if you're deferring income from year to year, every year, and certainly taken across the industry, it's primarily a deferral benefit that where one inclusion from a previous year would ordinarily tend to offset to varying degrees income deferred to a following year. So you have that kind of averaging out as well that mitigates the impact of the change. So I guess to summarize, to answer your question, one, if you have a real contingency, perhaps it's not included under the case law and general rules. If it is going to be subject on accrual basis, there's the option to use the lower of cost to market method. And then thirdly, if you have a number of files, some are billed, some aren't, over time one would expect the deferrals to even out.
Okay, so if a lawyer decides to base his or her own practice specifically on contingency fees, and there's no income in it in a year, they're expected to pay tax for what they provided.
So that's a situation where the lawyer has no revenues in the year.
Yes,
And
just expenses.
right. And you say it's on a contingency basis.
Yes.
But as I said, there is case law to the effect that if there's real uncertainty about whether you'll get it or not, then it might not be included in the year.
Well, how do you define what's a winning case?
You'd go to the case law and the Canada Revenue Agency.
And they're going to tell you if you have a winning case.
Well, for the criteria to help you determine if your case is sufficiently likely to result in income. But also you could have evaluation of the lower of cost to market.
It's low income. Yeah, okay. So if we're going to treat things like inventory, if I was a grocer and I had inventory that would go bad, technically I can write that off, correct? I don't have to pay tax on stuff that has gone bad. Is that correct?
That's right.
Okay, so if I get a case on contingency that goes bad, I have to pay tax on it. Because you're not going to know that the case has gone bad until you've reached a conclusion, which, due to our court system, we don't have the fastest system in the world. I know in Vancouver they actually closed family chambers for a day because they didn't have any judges. And people, by the way, still had to pay their lawyers. But of course, if they're on contingency, I guess the lawyer would have to pay tax for that day.
To answer your question, there are a few things I think that are implied in that. So when you say that a lawyer paid tax in 1 year and then after the end of the year determined the amount to be uncollectible or a bad outcome. So in the first year, they would have had to have made the determination that it would likely result in income. And again, it's the same sort of determination. If you have an engineering firm that gets paid at the end of a project, it's the world that they're already in. But for lawyers, of course, you have win or lose binary court cases sometimes. So if you made that determination, you include it in your income in year one, and then you have a write down in year two, then you would you'd write it down in year two, and you'd have a deduction or a loss in that year.
Okay, well, just again, there's so many circumstances. For example, you take someone's case, they're an elderly person who's been struck by a car, can't afford to pay you, so you go to try to get them some money, and a year or two down the line, when their court case finally comes up, they die. Natural causes, or maybe they're because of ill health. So what does a lawyer do in those kinds of cases where they have paid taxes? Do they get to apply for it back? Because it's lost time, which, by the way, to a professional is very expensive. So you know what I think may end up happening is you may end up finding where many lawyers might say, particularly in lower or more rural areas, where they just don't take cases anymore on contingency because they don't have the client base to subsidize them, to subsidize these extra taxes. I think I'm very concerned, Mr. Chair, that this is going to have serious impacts. And I shouldn't say I'm not making this up. First of all, I did work in a law office for about 1.5 years, and so I got to know clients, and I got to know how things don't work out the way that we try to arrange life. Life is very messy. The second thing, though, is I've actually been contacted by people in BC, members of the bar, who say exactly that the big firms in the big cities will subsidize these cases because they know that every 1 out of 10 may win big, but for the smaller firms in the rural areas, people will not be able to access justice. So I really am disappointed with this provision. But I have other things I'd like to talk about, but we'll get to some of
We'll
those.
come back to you a little later. Mr. Dussault, and then Ms. O'Connell. Mr. Dussault. We'll put you on the list too then here.
Merci d'être avec nous aujourd'hui pour vos explications.
Thank you so much for your explanations. Each time we hear you, I like to say that in Canada, no one should be ignorant of the law, and we expect all Canadians to understand tax law, to be able to respect it fully. And that is why I always ask and call for a simplification of the law so that everyone will be in a position to understand it. I'm looking at Section 16. I'm basing this intervention on some information documents. The explanatory notes on pension revenues, you were speaking of splitting pension revenue, and the changes here are mostly for retirement, income security, and the law at issue is for the reintegration of military veterans and service people. And could you tell us a little bit more of about the changes here? There's some sort of restriction here on the possibility of using income splitting, if I got that right. At page 27.
Silence
Right.
is golden.
No, this is a technical amendment that had been released in September of 2016 for comment. My colleague Pierre is more of a pension expert than me, but this is a technical tax amendment. What it essentially allows is for couples to be able to split the retirement income security benefit under Part 2 of the Canadian Forces Members and Veterans Reestablishment and Compensation Act for the purposes of pension income, the newish, I guess, pension income splitting rules. And the existing registered pension plan limits. So it allows, so it's an enhancement to previously announced or previously enacted rules to provide for the proper income splitting or proper splitting of pension income in the context of this retirement income security benefit.
OK. Fait que c'est pour clarifier la situation d'un...
So it's really to make pension issues clear regarding the Canadian Forces Members and Veterans Reestablishment and Compensation Act. Very well, and that's all I have for the moment, Chair.
Ms. O'Connell.
Thank you, Mr. Chair. Thank you all for being here. My question is in regards to the Ecological Gifts Program, and specifically around the change. Currently, it's proposed that the Minister of Environment and Climate Change must approve the recipient, and if I'm reading this correctly, the Act is to amend to the requirement that municipalities and municipal public bodies can perform this function on behalf of the government. Am I understanding that correctly? And if so, what is this process? How does the municipality, do they request this, or do they automatically receive this ability? What does this change look like in practice?
Thanks for the question. How it'll look like in practice is most eco-gifts go to what are considered qualified donees, so charities, so conservancy agencies. And there's a process now just to ensure the integrity of the program, that the Minister of Environment and Climate Change, or supported by her department, basically assesses the claims and makes sure it's that the gifts, that the arrangements are consistent with the goals of the program. So but as the legislation currently stands, where it's a municipality, there's no such verification or assessment required. It's an automatic process. So the idea of this particular amendment is to bring, basically to level the playing field, or to have equal treatment, so that sort of the due diligence that is performed will be performed for municipalities or other bodies performing a similar function as it is for registered charities.
I see. So it's not the municipalities approving, it's that they have to go through the process if they're receiving.
That's correct.
Okay. And then in regards to these changes as well, I guess there have been concerns or suggestions raised that, for example, when a charity usually, and sometimes they're established for the sole purpose, I know at least in my area there are a few in terms of conservation kind of groups become established and stewards of various land. And sometimes in doing so, there are costs associated with, let's say, the survey of the land or some of the acquisition that would come from it that the charity would pay so that it's not coming from the estate. But then there are treatments of that funding, it's not included in part of the gift. Is there anything that kind of deals with some of the costs associated with that transfer, that gift of the asset? Or is this not part of?
Yeah, no, I think what I can tell you is that's not part of the
Okay.
of this, any of the amendments that are proposed here.
Okay, thank you.
Mr. Garrettson.
Thank you, Mr. Chair. I just wanted to go back, Mr. Gowan, to the discussion that you were having about bill-based accounting. I do share some of the concern about how you're going to exactly track what was in a previous year and a new year, not necessarily with respect to pro bono, as Mr. Sorbera talked about, but more about those cases where individuals are, the deal, so to speak, with the lawyers, how it gets paid out afterwards. I'm not as concerned about the expenses, because I think that everybody by default is going to expense the costs as they're incurred in that year. But how do you, the first question is, how do you know that you, how do you know that you can accurately capture that after the fact? I mean, you don't know how much time you're going to put into it, into a particular case. It might go on for several years. Are you suggesting that the individual amount of time billed should be captured in each year and then reconciled later on? I'm just trying to wrap my head around that, and I was trying to listen to your explanation, and I didn't quite get it.
The amount captured in a particular year would just be the amount of income that's earned in that year, and
From like an hourly rate then? Because a lot of those cases work on a amount that is garnered in the decision, a percentage of that, 20 or 30% of that goes to the lawyer or whatever it might be. Like, how do you, like, it's going to be very difficult to capture that in a previous year when you don't know the outcome of what it will be.
okay, so first, I thought you were getting at like what at the end of the year, when you're determining how much to include in your income, do you take into consideration what's going to happen?
Right.
Your billings that are going to happen after the end of the year.
Right.
And it really is your work in progress of the amount that is accrued up until that point in time. So whether you put in 10 hours and plan to bill it out on January 15th, or
Right.
you think it like a municipal board hearing that could go on for another 10 years, that doesn't factor into how much you've earned during the year. At the end of the year, you have to make a determination of how much your work in progress is worth. So if you've, let's say you bill at $500 an hour and you've put in
But what if, sorry to interrupt, but what if the arrangement with the client is a percentage of what they yield as a result of the case? I mean, a store quite often will sell services for, or goods or services for different amounts depending on, they have to assess a whole bunch of stuff into it. So when I assess, if I was a lawyer, if I'm going to assess what my value in this particular case is, my hourly rate might be more if I determine that my outcome of a success is less likely, because it's more of there's a greater risk to me to do that. So I mean, like, are you suggesting that they just take their hourly rate times the number of hours that they had and then apply that?
Well, I think that in a situation where there's not going to be a premium billing and your recovery rate's at 100%, that's probably what you would do to determine the fair market value of it. Although there are other considerations, but that's not the situation you were talking about. You're talking about where either you bill 100 hours and maybe your recovery is higher than your normal billing rate or lower depending upon the outcome of a case, or perhaps it's contingent in the sense that you're going to bill X dollars per hour for the case, but there's some uncertainty about whether you're going to be able to collect at the end of the day or whether you'll just take a write-off. And that's where at the end of the year you have to make a determination based upon the facts of how much the work you've done to that point is worth, and what's the fair market value of it. It's difficult to put exact numbers on it, but if you've got $10,000 of work in progress and you make a reasonable determination that you're probably going to collect 80% of it, then it would be worth $8,000. But that's where there's the ability to come up with a fair value. As I said earlier, if it is truly uncertain, if you just don't know if you're going to win or not, or you don't know if you're going to get paid or not, there is case law supporting the notion that you don't have to include anything. And then thirdly, there is the ability to pick the lower of cost and fair market value method for inventory, where you have that file. And let's say you have, your costs are $6,000. You think your costs might be 10, they might be up to 14, they might be as low as 0, but you can, on the low of, so if you reasonably think it's probably going to be 10, you can pick the lower of cost and fair market value to take the $6,000 of cost. So you're insulated from that.
Okay.
To some degree.
I mean, I want to state for the record that I am actually quite supportive of the elimination of the bill-based accounting as it relates to certain professionals, as you've indicated here. But I do share a concern that it's going to be hard to capture that, and I think it's extremely important that CRA figure out how they're going to do that. To suggest that you're going to have to weigh the likeliness of success in, who's going to be the judge of that? A CRA, somebody in CRA? Like, how is that all going to work? I mean, I guess I'm just throwing that out there as a concern. The one other question that I want to ask very briefly, still in relation to this, is there a timeline, like a certain amount of time that needs to have taken place during the... So, for example, if an accountant starts work on December the 29th and finishes it on January 3rd, do you expect them to also split that into 2 invoices? Or is there a timeline, because there are a lot of people outside of the professionals, a lot of businesses that quite often do that, whether it's a tradesperson or whatever. They'll start some work and it's only maybe a week long, but it happens to go over that. Like, how does the timing work on that?
I thought you were going to ask a different question, which I was happy about because I'd forgotten to mention that as part of the consultation, this measure had initially had a 2-year phase-in period, which has been extended to 5. So in terms of timing, that's worth noting. That came out as a result of the consultation, and in fact from comments we'd heard from...
I'm glad you got to get that in there. But can you answer the question?
The CBA and others. But for that one, yes, assuming you have a calendar year end, which I'm sure was the case in your example, then for that year, the first year, you'd be taxed on your work in progress that accrued up till the end of the year. And you wouldn't have to send out 2 invoices to the client, but the amount you earned, the amount of income that accrued to you in the first year would be taxable in the first year, and the costs.
But for your accounting purposes, it's 2 separate invoices, or not invoices, but it's separated. So there is no time. It's just like if you start something on December 29th and end it on January 3rd, you would be expected to properly distribute that between the 2 years.
Yes.
Okay, thank you.
Okay, thank you. Then on my list, I have Mr. McKay, Mr. Polyev, and Mr. Dussault.
Thank you, Chair, and it's a great pleasure to be at the second best committee in the Hill.
What's the next one?
Pleasure to work that one out. On the notes here, it says, introduce new rules to introduce the taxable income of federal credit unions be allocated among provinces and territories using the same allocation formula applicable to taxable income banks. What does that mean?
Currently, if a bank operates in more than one province, they have to allocate their income according to which province they earn it in. With recent rules affecting federal credit unions, this would essentially provide the exact same set of rules for credit unions to allocate their income as between
So is this
provinces.
something that credit unions have been asking for?
I believe so. I mean, I don't want to misrepresent things, but of course they need certainty. I remember, I think they had asked for that because they want. You'll see that I think it's in Regulation 404.1, separate from 404, which is for banks, because there was some desire to not be just treated as a bank. But it provides certainty and clear rules for credit unions in determining what income is allocated between provinces.
Provide certainty and clear rules for credit unions. Another thing to provide clear rules and certainty to credit unions who are bad things. And so the question really is, if the credit unions are not asking for this, then why it would be here. I kind of agree with the general principle of financial institutions being treated equally. However, credit unions have unique capital challenges, as you well know, and I don't know whether this actually works for or against them.
Unions as a witness, Credit Union Central.
I think that would be a noble thing.
We will
so
have to try and do
I'll
that.
move on if that's not a good.
I can't say with certainty that they came to the department and asked for it, but it's not something that we've heard concerns raised about. We released in September of 2016 these proposals for public consultation, and I don't believe we heard any criticism of the proposed allocation. And I know that we'd put credit unions separate from banks in order to accommodate their requests.
Just to federal credit unions or all credit unions?
Well, it would have to be. It would have to have income to be allocated between.
It looks like it's it looks like it does federal. Okay, I'll just move on because I don't want to use colleagues' time. The Clean Energy Accelerated CCA. Is that CCA similar to other energy sources other than geothermal?
Yes, it's that type of treatment, the accelerated capital cost allowance, which is basically just tax depreciation. In class 43.2, it's a 50% rate, and that can be available not just as proposed for geothermal, but also for wind, solar, small-scale hydro, and a few others.
Are these accelerated capital cost allowances then for that class of energy producer?
That's correct.
Okay. And is that class different than, say, carbon-based energy producers?
Well, the accelerated capital cost allowance rates in class 43.2, which itself builds on class 43.1, are only available in respect of the specific types of projects listed in that class, and they're all, I think it's fair to say, what you would consider green energy projects. Separate from just sort of the general rules that might apply to other companies.
Again, I'd kind of see treating all energy sources as in similar CCAs, but there may be an argument to be made for non-carbon based energy products to have an accelerated capital cost loan. So if that could be answered, I'm sure that's useful to the committee.
Yeah, in terms of, there is no question that in terms of Class 43.2 items, the idea is to provide a faster rate of acceleration for those products, with the idea that they're aiming to,
stimulate an industry.
Industry, but well, and also just it's for for cleaner environment, et cetera, on that front.
So there is a public policy goal.
Yeah.
You say here under the anti-avoidance rules, these measures will extend to the application of anti-avoidance rules to RESPs and registered disability savings plans. Is there some? I don't understand how you could use an RESP or a disability savings plan to avoid taxes. Is there some? What's the public policy harm being addressed here?
These anti-avoidance rules developed in the context of RRSPs, mainly in tax-free savings accounts, and perhaps the potential harm is clearest in those cases, but also definitely seen in the RESP and RDSP sphere. There are essentially three different concerns that are addressed by these rules. One is improperly removing value or property from a tax-deferred account. Classically, if you have money in an RSP, if you're taxed on the way out. And so it prevents the avoidance of that. There's getting a deduction for, or some sort of other tax benefit for contributing amounts to a plan. And then there's also the inappropriate shifting of income to a plan with certain tax advantages. Very simple example might be if I had an account and I put in $100, use that $100 to buy shares of a company I control, and then paid as much dividends as I wanted into it in order to just shelter all my money in, say, a tax-free savings account.
So people actually shelter their money in RESPs?
Well, no. That's kind of the harm that these anti-avoidance rules were intended to prevent. And these measures, I mean, one, they provide for a consistent set of anti-avoidance rules that apply across the different vehicles, from RESPs, RDSPs, TIFSAs, RSPs.
So you're applying anti-avoidance rules to all classes of these savings plans, even though there's no real evidence that RESPs and disability plans actually engage in anti-avoidance rules, or avoidance of tax.
Most of the anti-avoidance activity we've seen had been in the RSP and TIFSA context. Less so in I think it's fair to say the RDSP and RESP context, but the potential is still there. And,
okay, so this is a potential abuse that you're addressing rather than a reality of abuse.
Well, currently there's inconsistencies in the tax treatment of different deferred plans. And so for simplification benefits and the benefit of having a more coherent tax system, there's certain advantages to having one set of rules apply to everyone instead of more of a piecemeal approach. But then also, there's gaps in the rules that could be exploited, and with these would proactively prevent abuses in those two types of plans.
Yeah, I understand the symmetry one might want as a tax official. It just, again, the reality and the practicality is maybe something less than that. Finally, I share the general concern expressed by Mr. Gerritsen and Mr. Albus concerning the bill-based accounting. Having practiced law for 22 years, I would look at this as just a major headache, an absolute delight for my accountant, and a conflict for my partners, because one partner would probably do the work in progress stuff, and the rest of us would be doing cash or something very similar, where the action and the bill and the activity were closely linked. What I don't get, since this is one just great deferral, started out at 2-year deferral and now a 5-year deferral, or not a deferral, that's not quite right. Phase in. I don't see the public policy gain in this activity. You initially, when you started, you essentially moved a whole bunch of work in progress into income, and you whack the tax. Now you've pushed that out over 5 years. I don't see the revenue gains to the government now that you've been effectively moved from 2 years to 5.
I think there are maybe a couple points to that, if I understand your question correctly. One, you'll see in the revenue estimates published as part of the budget supplementary information that in fact, when it was initially a 2-year deferral, there was a short 2 or actually 3-year period of income inclusion, extra revenues for the government, and then it went down to 0, representing the fact that it was a timing change. And so you're absolutely correct that we'd not booked any revenues after the phase-in period. Of course, moving from 2 years to 5 years would prolong that phase-in and would reduce, of course, the impact per year for affected professionals. In terms of the public policy, this arose as part of the tax expenditure review undertaken by this government over the past year, more than a year. And they looked at all the tax expenditures, deferrals, and the like available, and determines which ones continued to meet a good public policy goal and which did not. In the 1980s, taxpayers or professionals other than the enumerated professionals in Section 34 were required to move from a bill basis system over to an accrual accounting system, and that was seen as and that was seen as providing a better recognition of income, a truer picture of income, with the idea that under the tax system, and you can look at the IKEA and Canderel, Supreme Court of Canada decisions. The goal is really to provide the truest picture of income in any year to determine the most appropriate base for taxation, and the ability to elect to defer income until a bill is sent out under bill basis accounting was seen as a deviation from that ideal system, and it was done, as I understand it, in the 1980s, in part because of the different regulatory landscape of the time, and in recognition of the fact that back then the enumerated professionals weren't able to access a lot of the benefits available to incorporating their businesses, and of course that's not the case anymore. So the original justification for excluding those professionals from the general rule, which provides the truest picture of income, was no longer available, and it was considered to be inappropriate to maintain the election.
Yeah, I'd like to carry on this conversation about going from cash to accrual to modified accrual to value or bill-based, whatever it is called now, bill-based accounting. But I'll defer my time to my colleagues because they'll get a little upset with me. I wouldn't want the chair to be upset with me.
That's a great idea, John. I would take the opportunity to remind members that we have 17 sections to get through, and we're on section 1. It will be the longest, no doubt. So Mr. Polyev, and then Mr. Dussault, and then Mr. Fergus.
Thank you. I want to follow up on the questioning of Mr. McKay regarding the registered disability savings plans and the anti-avoidance measures that the BIA would institute in regards to those plans. I'm still not clear on exactly how someone would use an RDSP in order to avoid paying tax that one ought to pay.
One example of a transaction where you could, so in our RDSP, it's set up as a trust for the benefit of a disabled individual.
Yes.
And it's tax advantaged in the sense that it allows for the trust to have access to the graduated rates that are normally only available to individuals or natural persons, whereas trusts are typically taxed on their top marginal rate. And so there would be an incentive for a top rate taxpayer to shift income to a disability savings plan, a registered disability savings plan, to access the lower tax provided by the marginal rates, leave it in that plan, earning income subject to lower rates, and then at a later time using one of the schemes that the anti-avoidance rules are designed to prevent from extracting value from the registered disability savings plan to their own benefit, as opposed to paying them out to the benefit of the disabled beneficiary. So that might be one example.
Doesn't the plan have to be paid out to the beneficiary?
Yes, that's absolutely the policy, and that's
currently the policy, isn't it?
That's right. And
okay. So how would they, under the scheme you just described, how would a non-disabled person improperly use an RDSP to accumulate low tax gains and then pocket them himself rather than have those gains go to the disabled beneficiary?
One example could be taking funds from the RDSP and investing in that individual's into a corporation owned by that individual. That would be a prohibited investment under the anti-avoidance rules. And thus, if you put in $100, to use a simple example, into a registered disability savings plan, kept it in there to access the lower rate schedule, or lower rate, marginal rates, I mean, and then when you wanted access to the money, invested in one of your private corporations. Let's say that it was now $120 because you earned income over a number of years. Take that 120, invest it into a corporation you control, or lend it to a corporation you control or yourself, and then the money ends up essentially back into the hands of the person who established it. Again, you can see that as being more enticing tax planning in the world of registered retirement savings plans and TIFSAs, where income earned in the registered plan is tax-free.
What is the contribution limit currently for RDSPs per year?
Well, there's a $200,000 lifetime limit.
Lifetime limit, and that can be contributed at any point throughout the lifetime.
Yeah, we'll have to. I think it's just on the basis of a lifetime limit. We'll follow up on that.
Okay, and TFSAs are. Are you seeing people use TFSAs to invest in private corporations in order to enjoy tax-free returns they shouldn't be?
When the tax-free savings accounts were introduced, they contained a number of, at the time, kind of cutting-edge rules to prevent that type of planning, and there were amendments made shortly after the TIFSAs were announced. But they had a pretty comprehensive and strong set of anti-avoidance rules that came out with them. And some of those were later extended, actually, because they worked so well to our RSPs. And using that as a model, they would be, in this bill, extended as well to RESPs and RDSPs. So the TIFSAs themselves, when they were introduced, never allowed somebody to do that because of the obvious anti-avoidance concerns.
So back to the RDSP, can they be invested in private corporations right now?
No, I think you still have to have a qualified investment. That's just an example of the type.
But sorry, just clearly speaking though, can the proceeds of an RDSP be invested in a private corporation right now?
No, no, I don't believe that it can.
Then that scenario you described at the outset is impossible, where someone would use an RDSP to invest in a private corporation and then use the RDSP as a vehicle to avoid paying tax on returns. That's not possible if you can't invest in a private corporation through an RDSP in the first place.
I don't know that it's not possible. Rather, if it happens, certain consequences arise. You have a penalty.
Okay, but that's already the case.
Right. But the penalties to be introduced here are different, and I think in many ways stronger. Like you have the advantage tax, so income on a prohibited investment is subject to 100% tax, which is very strong. I can provide a more detailed comparison, if you'd like, on the differences between the current and proposed schemes.
Yeah, I just worry whenever we have officials who come with new rules and they can't tell us why we need the rules, I become very concerned that we're imposing costs and restrictions on people without any purpose. So I would appreciate some explanation as to how these anti-avoidance schemes could even occur, given that the practice that you described at the outset is already forbidden under the existing law. Moving on to the exploration expense changes, you said that in cases where an exploration for oil well development is successful, then the expense associated with that exploration would be deductible at a rate of 30%, whereas if it's unsuccessful, it would be deductible at a rate of 100%. Did I understand that correct?
So, so in terms of exploration, basically the sort of a measure is to deal with discovery wells and how those will be treated. Those wells would end up being, when they're they would be treated as development wells at 30% unless they're proven to be unsuccessful or deemed to be unsuccessful, which in that case they would then become exploration expenses, which are deductible at 100%.
So that's a yes.
I guess what I'm trying to get at is, I think it might be the same. What it is that those discovery wells will be treated to start off with as development expenses at 30%, okay? And you don't necessarily know whether they're going to be successful or unsuccessful at that point in time. But to the extent that they then prove to be unsuccessful, that discovery well proves to be unsuccessful, then it could become exploration and deductible at 100%.
Yeah, I still think that's a yes.
Okay.
Going back then to the point, so if a company invests $100,000 to explore whether there's oil underneath the prospective well, and that well turns out to be a dud, then they can deduct 100% of the costs in 1 year.
Correct.
And if it turns out that they invest that $100,000 and that well turns out to be a cornucopia of oil, then they can deduct that at 3 years, over three and some odd years, 30% rate. Okay. But what if they only figure out whether it's a dud or whether they've struck gold, black gold, in 5 years?
So in terms of the deeming rules, that's where it gets into the idea of it's deemed to. One, if you prove that you're unsuccessful, that's an immediate, and once you do that. And two, if
but what if it takes some time to figure out whether or not the well is going to produce oil?
Correct. So there's two sides to that. The first side of it is that if they haven't produced anything within 2 years, then it's deemed to be unsuccessful, even if, like, let's pretend that they end up eventually producing something from it, it's deemed to be.
So they go back, then in that year, so in the second year they realize they've got a dud. Then they have to go back a year and write off an expense that they were not originally allowed to write off in an earlier tax year that will now have been closed out.
They could do that, or they could write it off. It becomes something that they can write off right there for going forward.
Right.
Yeah.
Okay. Because it just seems like, again, another rule for that's going to add complexity, particularly to small business, because this is a tax measure related to small business. It's only available up to $1 million for smaller exploration companies, the juniors in the oil and gas sector. And you're now telling them they have to wait 3 years before they can write off an exploration cost in 1 year.
Just to clarify, there's two measures with regard, and when you said exploration in a general sense, I then went with the idea that you were talking about the discovery well measure. There is another measure with regards to reclassification of exploration expenses, of Canadian development expenses for flow-through share investors. That's a different measure altogether, the one that's for smaller companies. What that measure is an expense that is a development expense. In the normal context, it's a development expense, and therefore it would normally only be deductible at 30% for that company on a declining balance basis. That company, those particular measures, can say, essentially reclassify that and say, we know it's a development expense. It's a development expense only normally deductible at 30%, but we're going to let you reclassify it as exploration expense, which it's not in any other context. It would not be considered an exploration expense, and allow it to be deducted at 100%, but it's not actually the company in that case that's actually deducting it at 100%.
The shareholders.
And in particular a person who, a shareholder that buys a flow-through share. It's a special, like, that basically with that flow-through share, they get a share, but also access to the deduction. So let's pretend it was a development expense of $100.
Right. So for a successful oil well exploration, under the status quo, what could with the flow-through arrangement, how much can they write off under the status quo?
With a successful flow-through share arrangement?
Successful exploration of an oil well with a flow-through share. Yeah. How much can they write off of the expense in year one today?
Okay. So
today, under the status quo.
In that context, it doesn't matter whether it's successful or not, is why I'm trying to...
So, okay, perfect, got that. Now, how much would it be?
Okay, so the actual investor would be, let's pretend it's $100 and it gets flowed out to them $100. They would be able to write off, and the investor would be able to write $100.
Right. And what you're saying now is that if it's a successful exploration of an oil well, that shareholder will only be able to write off in the future, under this change, $30.
No, because it doesn't. That's where I'm saying the success. What we're talking about when we're talking about that measure, it was a development expense. It never was. It wasn't an exploration expense. It's only by sort of being designated as it's basically put into the class, and let's put it that way. These development expenses that would normally be called Canadian development expense as at 30% are deemed essentially to be Canadian exploration expenses, which are deductible at 100%. So that's why they are able to deduct them at 100%, because we deem it. It's not that it was successful or not. It was a development expense that we deem to be an exploration expense deductible at 100%. That's what's being impacted. That's why I'm saying it's not really a success or not on that issue.
But under the proposal, they'll only be able to claim 30%.
Correct. So that development expense that's normally 30% that was deemed to be a Canadian exploration expense that they would be able to deduct at 100%. You're right. They would only be able to claim it as a development expense at the 30% rate for those development expenses. Yes.
Regardless of whether they're successful or not.
Regardless, it's not a success thing.
Final question: how much money is lost through the deferral of taxes because of the use by professionals of the billed basis accounting?
The estimates that were included as part of the budget were $425 million over the horizon mentioned in the budget. That, as I said, was based upon a 2-year deferral. So it would be extended beyond the cutoff date of 2021.
So every 2 years, you're telling me that professionals are saving a total of $450 roughly $1 million by deferring by paying tax on billings in the year that they are actually received?
No, the elimination of the deferral, which would bring into income all the deferred income, would total $425 million, but it would be once there's a move to the accrual system. You'll see in the budget materials there's no revenue projections beyond the 2019-2020 year. Of course, that would be later. Under the revised proposals, I don't have the revised numbers with me, but with the phase-in period going from 2 years to 5, the revenues in each year would, of course, be lower, and the amount of time before it goes to nil would be longer. But
now, can you just tell me why it goes to nil?
Because it's a timing question, and
right.
It's just dealing with a deferral. As I said.
But I guess what I'm getting at here is, if it's just a timing question, the professionals in question are not avoiding paying tax. They're paying it a year, at worst, a year later, by virtue of the fact that they're paying it in the year they actually received their billings, as opposed to in the year they did the work, right?
Well, it's a deferral of tax. It's not an absolute savings.
Right. So what problem are we trying to solve here? Revenue problem?
But it's
like, I mean, it seems sort of punitive. Like, you know, you're paying your tax next year instead of this year. We're going to go get you, because accrual accounting says that you have a receivable on your book in the year you did the work rather than the year you got paid. And we believe in accrual accounting, so pay up even if you don't have any money to pay with.
Well, with the time value, deferrals are quite valuable, and a significant portion of tax planning is attempted or aimed at achieving tax deferrals rather than absolute savings. So I'm not certain that a deferral represents a nothing.
But what does it represent then? Because I'm asking, what is the monetary value of this deferral right now? Does your department have any estimate?
Well, it would bring into income over the time horizon $425.
No, but that was not the question. That will move tax liabilities forward. That won't increase the amount of tax paid. That's the 400 and some odd million you just listed. That's not additional revenues that the Government of Canada will get over time. That's revenues it is pulling out of future years into present years. So what is the monetary value of the deferral you're eliminating with this measure?
If you're asking what the anticipated revenue increase is after the end of the phase-out period,
yes.
You can see from the table that was included in the budget that it's nominal, or it's dashes, so it would be less than $500,000 a year.
25,000?
Less than 500, I think, is what.
Less than $500,000 a year. That's what the government spent since you and I started this conversation. I mean, like, it just seems like we're going to bill people for money they have. We're going to tax people on money they haven't actually received, and might never receive. We're going to create the administrative nightmare of them having to go back to CRA when their client defaults on a payment. And say, listen, CRA, I know I paid you tax on that money I never made. I can now confirm I'm never going to make it. Can you please give me a refund on that non-existent income. Also, the Government of Canada can raise $500,000.
I think the officials can answer that part.
That's all.
That it? Okay. I can see where we're scheduled to adjourn at 5:30. I know there's a lot of people here from various departments. I would say we will not get beyond part 3. So anybody who's here that's after part 3, except I believe part 3 and 4 are the same witnesses. Anybody beyond that, you're released. We'll be talking to you another day.
Because I do want to bring up Division 2 of Part 5, the Asian Infrastructure Bank.
No, we'll do that another. We're going to have to do it another day.
Okay.
Yeah. No, gentlemen, we still need you though. Just we got 3 more. We still got 3 more questioners on this part 1. But I'm just saying, for officials that are going to sit here for another half hour or 35 minutes, you might as well be released and head out, because we're going to have to call you another day, which is not unusual at this committee. So thank you for coming. Okay, I have on my list Mr. Dussault, Mr. Ferguson, Ms. Cara.
Merci, Monsieur le Président. Et,
Thank you, Chair. And thank you to all those who came to the committee, and I wish you a very fine evening. My question is about Section 30. Often, this isn't the first time you will hear me referring to this. It's about the sections that are retroactive, that are applied retroactively. And in this situation here, it is retroactive to the 24th of October 2001. I find that somewhat worrisome, seeing tax legislation that has a retroactive effect. So could you just tell us what is being suggested here at Section 30? Here they are trusts and related foreign enterprises. Could I just hear what justifies making that retroactive 16 years back? Why that date in particular?
Page 50. And oh, right. That's probably the reference to in subclause 30 sub 1. Part of the package of technical amendments and released in September of 2016 are intended to be technical kind of housekeeping measures. And many of these correct oversights and mistakes made in past bills. This is a case where the Canadian Payments Act, the name of it had changed several years ago, and whenever the amendment is effective. And so this, and when the name of the reference statute was changed, the reference in the Tax Act was not changed to follow it. And so it doesn't have a substantive effect, but it corrects the incorrect reference back to when the change ought to have been made. So,
il n'y a pas d'impact fiscal nécessairement.
There won't necessarily be any effect on taxation of this change. It's just a matter of clarifying something.
Okay, je vais m'en tenir à ça pour l'instant, Monsieur le Président.
But that's all I have for the moment, Mr. Chair.
Yes.
Just for committee members to think about between, Dan, for committee members to think about between now and 5:30, our options for fitting in 2 or 3 more hours next week are Monday afternoon, Tuesday morning or Thursday mornings. So if you got any special thoughts on where you'd like to be on those days, I'd like to hear them. But Dan?
Well, perhaps what we can do is just have members identify which sections that they would like to have extra scrutiny on, and then just invite those.
I think we do need to hear the explanation, though, on each section.
Well,
most of them, we've asked them to be fairly short on those explanations.
I noticed the parliamentary secretary wants to ask questions of officials. However, I think she, can ask for those things at other times as well. So this is a chance for parliamentarians that do not have access to officials on a regular basis to be able to ask questions. So rather than hold up meetings and cancel schedules, because we've tried, especially on the opposition, we've tried to work with the government on the scheduling of their BIA. This is we've been very cooperative thus far. I would hope you would attest to that, Mr. Chair. Yeah. So, if perhaps what we could do is focus on those things. I do realize that there is, we want to hear on everything, but there's a bit of ragging the puck that goes along with that as well.
Okay, so if you have a suggestion, let me hear it. And for the parliamentary secretary, for this particular parliamentary secretary, the two of them actually, there's departments that she's not parliamentary secretary for here, so I think she certainly can ask a question. That's her right. Ms. O'Connell?
I had suggested this, I think, at the sub-meeting, but the officials have to come back when we do clause by clause anyways, and are available for questions. So I agree with Dan in the sense that if there's anything that members, before making amendments, any sections we absolutely want questions on. But there is always that opportunity when we do clause by clause that officials have to appear and be available for questions. So if we can find that compromise and not bring everyone here unnecessarily.
Okay, we'll give that some thought. Then we're going to Mr. Go ahead.
If I could just make the suggestion, let's do Monday then.
Is you folks okay
Monday
with
afternoon,
Monday?
After question period.
Okay. All right. That's where we'll go. Mr. Fergus, you got a question. You're on deck for questions.
Merci beaucoup, Monsieur le Président.
Thank you, Chair. And thank you as well to our officials for being here with us. My question is back to the accounting based on billing. Billed basis accounting. I'm not an attorney, you see, so I'm not an expert in this legislation either, in tax legislation. But that said, I would like to make sure that I've really understood the reasoning and the basic policy underlying the proposal that we make these changes. So if you could do this in a couple of minutes, but no further, because I'll have some further questions. Just tell me the story. Tell me why it's really important to make these changes. What are the problems that we're trying to solve by doing so? And how will these changes really lead to solving the problems?
Of the general tax rules and tax system, and this comes from Supreme Court decisions, IKEA, Canderel, is that the tax rules ought to provide taxation on the truest picture of your income. And to that end, the basic scheme of the Act, currently for large majority of taxpayers, requires accrual accounting, so that in a year you pay tax on the amount that you earn in that year. Back in the 80s, as I said, there was a general shift in the tax rules away from what we've called billed basis accounting, where you include something in income when you send out the bill, to this more comprehensive, truer picture of income accrual system. Exclusions were made back then for certain designated professionals. Of course, lawyers are on the list, but you also have doctors, chiropractors, I think maybe veterinarians, and others. But the reasons for excluding them from the general rule, which provides the truest picture of income, no longer exist right now. And so as part of the tax expenditure review, it was determined to be inappropriate to provide for continued access to this tax deferral, rather than having the rules that apply to the general rules that apply to taxpayers, and this could include other professionals like engineering firms and the like, rather than have two sets of rules with a favored category and then the general one.
Les conditions ont changé parce que
Conditions have changed based on the questions that I hear from all political parties, not only the current government, but also from the opposition members here with us. This might really be the core of the problem. It seems that my good colleagues aren't really convinced that the context has shifted and that shift justifies putting an end to the exceptions.
Proposed measure arose in the context of the tax expenditure review, a comprehensive view of the system of tax expenditures we have in the Act, looking at not just tax credits but also preferential deferral systems like we have here. Outside experts were brought in, and it started well over a year ago, and the decision was taken that now with the different regulatory atmosphere, perhaps increased sophistication in accounting tools, that it was an appropriate time to make this change and to eliminate that preferential deferral regime for the designated professionals.
Si je comprends le langage corporel, Monsieur Leblanc.
So if I understand correctly, do you have anything to add, Mr. Leblanc? Looks like you might have. No, that's fine. Well, it seems that in certain situations, and let's look at lawyers, given that they have been used as an example, and I'm concerned when colleagues of any political stripe ask about situations where billing will be put off until later, will be deferred because, let's say, there isn't a decision rendered in a case that they undertook to represent, or they might only go about billing if their client is successful in court. It seems that those might be good reasons to maintain the current regime. Am I wrong?
Regime for the designated list of professionals, and it's important to keep in mind, I think, that the general rules apply to not just industry generally, but to other classes of professionals who have for many years, decades even, managed to make estimations of what their the fair market value of their work in progress is, and have been able to work within those rules. And there's guidance both from international accounting standards and the Canada Revenue Agency on how to appropriately apply accrual accounting to fairly specific fact situations. And so it essentially puts these excluded groups on the same playing field as others, and others who have been able to comply with the rules for quite some time.
Est-ce qu'il y a d'autres juridictions internationales?
Are there any other international jurisdictions, any other countries outside Canada that have adopted the same approach, or the context there might be similar to ours? Are there examples of any other countries? where they have done away with these preferential treatment approaches.
That basis for their taxation, but that's just because I'm not aware of any. I can ask. I simply don't know the answer to that question.
Merci beaucoup, Monsieur le Président.
Okay.
Thank you, Chair.
I just want to say on the parliamentary secretaries too that I had forgot about as well, that the standing orders changed and were effective September 18th, that parliamentary secretaries are now members of the committee, non-voting members of the committee on the standing orders since September 18th. Mr. Karen.
Thank you, Mr. Chair, and I just have one quick question, so I do appreciate you giving me the opportunity to ask this question. Could you just elaborate on your point on adding the nurse practitioners to the list of medical practitioners that can certify the impacts of impairments for disability tax credit applicants? Obviously, this is extremely important for so many Canadians that don't have access to family doctors or medical doctors. But you mentioned it goes beyond the disability tax credit. Could you just elaborate on that? Thank you.
Sure. Thanks for the question. So in Budget 2017 itself, there was the measure on the disability tax credit to add nurse practitioners to the list. And that was legislated as part of the first Budget Implementation Act. So basically what's being added here is an extension of that, because there are certain other provisions in the Income Tax Act where there are specified medical practitioners that can certify different things. Let me give you an example. For the child care expense deduction, normally it's the lower income spouse who's eligible to claim the deduction. But there's a provision that allows where the lower income spouse has a severe impairment, then in that case, the higher income spouse is able to claim the child care expense deduction. So it's a question of who can certify that status. So nurse practitioners will be added. So it's sort of taking that logic and extending it to some other parts of the income tax system.
Was all.
That's it. That's all. We're all in. One more question, Mr. Albus.
Oh, I don't know if it's
however
one
many
question.
you got.
No, thank you. I just wanted to talk a little bit about the disposition or charitable giving of land as it's laid out. I believe page 106. So again, in regards to some of these things, that the disposition or changes made. So first of all, I think one of the things that says, in the opinion of the Minister of the Environment. So are we basically allowing the Minister of the Environment to designate ecologically sensitive lands? And
that's basically how it works now, is that the program is administered by the Department of Environment and Climate Change. It's the Minister who has responsibility. So she's responsible, in this case, for designating on a gift-by-gift basis. So if it's donated to a registered charity, by way of example, the Nature Conservancy of Canada, she basically certifies that it meets the purposes and goals of the measure. And the idea here is to apply that same logic to municipalities and similar bodies.
Okay. That seems at least reasonable to me. And lastly, in regards to the closing so-called loopholes, I think you might want to amend your use of language in the future, because apparently loophole is now something that, I think it's closing advantages surrounding the capital gains exemption on the sale of principal residence. I've had a number of people that are quite concerned. Obviously, this year's tax, people had to note if they sold their principal residence, and I've had people ask me, where's this going? So can you maybe just go over that one particular area again, and what pages it's on?
The key there is it's a very important measure, the capital gains exemption for principal residences. And I mean, it's something that has strong support. So the idea is to make sure is that it's being used by people for whom it's intended, that is Canadian residents living in principal residences. And Trevor, maybe you can speak more to this, but the idea here is to be better able to screen out non-residents who haven't through certain provisions have been able to claim the principal residence exemption when that was not intended. So the idea is it's an important part of the tax system and to make sure that it continues to work well.
Can you give me an example?
The principal residence exemption gives you an exemption on the sale of your home, one per family, and it's limited to Canadian residents. If you sell your home partway through the year, you'll most likely buy a new home if you're moving. So you'll have had 2 principal residences in that year. And as I said, you can only have 1 principal residence at a time. So to get around that problem, where you don't want to preclude the principal residence exemption just because you moved, the rules give you a plus 1 year. They say, well, we'll take a look at when you owned the house, and we'll give you plus 1 year on it to take into account situations where you move. A technical issue arose where if you had a non-resident who engaged in certain planning and sold a Canadian house or real property, that there was an argument that they could claim the principal residence exemption for that 1 year because of that plus 1 that was given in order to make sure that the rules worked for Canadians who moved from Toronto to Ottawa, say. So that's an example of what might be called a loophole.
Okay, is there any loophole or advantage? Sorry, I'm trying to learn the new speak here. Is there anything that would apply to a Canadian citizen?
Not to residents of Canada.
So this is only for non-residents?
That's the idea. Another example would be non-residents using Canadian resident trusts, basically as a way to access the principal residence exemption in a way that wasn't intended.
Okay, so this is them. So this is again someone who is a non-resident that is could use other entities to purchase the property and claim it through that way.
It could also apply. Citizenship doesn't tend to matter for Canadian income tax purposes.
Yeah,
it's
a resident or
residency. Okay. So there are changes relating to the use of trusts to claim the capital gains exemption that it essentially restricted to certain classes of trusts, like spousal trusts and the like. And those, just to be clear, could prevent multiplication of the principal residence exemption as between Canadian residents. So, but certainly the measure that I discussed with the plus 1 year and that loophole is purely, and a lot of the trust planning where non-residents come in and buy Canadian property through a Canadian resident trust is targeted at non-residents. But I don't want to say that there's no way that some of the trust changes can't affect Canadian residents.
Okay, fair enough.
Then thank you, gentlemen, for spending an hour and 20 minutes with us, or longer than that, an hour and 50 minutes. Okay, we'll call up the witnesses for part 2, see if we can at least get the summary done. Maybe we can get it all done. Thank you, Mr. McGowan, Mr. Frieda. Quality time.
Of course.
Indeed.
Do you have,
Okay, thanks. So, we are looking at Part 2, amendments to the Excise Tax Act and to related legislation, GST and HST measures. With us is Mr. Misil, who's Senior Legislative Chief, Sales Tax Division, Finance Canada, and Mr. Kibana, I mightn't have that right, Legislative Chief, Sales Tax Division, Tax Policy Branch as well. welcome. The floor is yours. I'm not sure who's starting, and thank you for your endurance.
Bonjour. La partie 2 du projet de loi.
Hello. The second part of the bill brings changes to the GST and the HST. The changes begin at Section 106 and go to 168, and I will describe them in the order in which they appear in the summary, with one exception for a couple of measures that are linked.
The bill are technical in nature and generally correct small deficiencies to ensure that the rule applies as intended. All of the measure in Part 2 of the bill, except the PSB rebate measure, have been released for consultation the first time in the summer of 2016. These measures have also been confirmed in Budget 2017, and they were re-released for consultation in the summer of 2017 with a small number of improvements. No requests for amendment were received from stakeholders during the second consultation. The first measure makes technical amendment to the GST-HST pension plan rules. Existing GST-HST rule ensured that pension plan receive the same GST-HST treatment whether pension expenses are incurred by an employer participating in a pension plan or directly by a pension trust or a pension entity of the pension plan. These rules also generally provide a 33% GST rebate to pension trust and pension corporation in respect of their expense and their expense that are deemed to have incurred. These rules are fairly sophisticated, and they came into force relatively recently in 2009, and certain small deficiencies and mistakes have been identified over the year by stakeholders and internally by the government. So the proposed measure makes technical amendments to these GST-HST rules to clarify certain points, correct technical deficiencies or error, and simplify compliance. The second measure I'm going to talk about deals with GST-HST treatment of master trust and master corporations. So master trust and master corporation, what they do is they hold and invest fund of individual pension plans and a pension plan corporation too. And they do that in order to diversify the risk and reduce the costs. These amendments ensure that the same GST-HST treatment applies to pension plan related expenses, whether the fund of the pension plan are invested directly in a trust or corporation of a single pension plan, or whether the money is being invested in a master corporation or master trust. The third measure I'm going to talk about, and it's part of the first item in the summary, there's a measure to make technical amendment to the GST-HST rule for financial institutions. So financial institutions are subject to special GST-HST rules, and this is due to the complexity of the financial service industry. And it's also because financial services are exempt under the GST-HST, financial institutions are generally not allowed to recover through input tax credit the tax they pay on expenses they acquire to basically provide those financial services. So which is contrary to the general commercial activity business where they charge tax on their output, but they claim an input tax credit on their inputs. So also these rules are fairly sophisticated in certain cases, and technical anomalies are identified from time to time. So the measure here makes technical amendment to these rules to clarify certain points, reflects amendment to the Income Tax Act that basically our concept of the Income Tax Act are referred to in the Excise Tax Act, and sometimes there's modification in Income Tax Act and Excise Tax Act has to catch up. And also there's rules to simplify compliance. The fourth measure, which is the third item on the summary, it makes technical amendment to the GST-HST drop shipment rules. The drop shipment rules help Canadian businesses that sell to non-resident by ensuring that non-resident business do not incur unrecoverable GST-HST when they acquire goods in Canada. So the amendments that are made to those rules, they provide a new tax relief mechanism, and this is a situation where an existing tax relief mechanism was not functioning for technical reasons. The amendment also extends the application of the drop shipment rules in respect of certain leased goods and generally make technical improvement to those rules. The next measure relates to municipal transit. Municipal transit services are exempt under the GST-HST. This measure clarified that the GST-HST exemption for municipal transit service also applied to supply of tickets, passes, and other similar rights entitling individuals to receive municipal transit services. The amendment is proposed to reflect the modern way in which transit services are supplied and paid for, which can often be better characterized as supplies of rights as opposed to supply of service. In practice, these amendments do not change anything because they simply codify the relieving ways the CRA have been interpreted the relief over the years. The next amendment improved the manner in which public service bodies can claim public service body rebate. For the purpose of the GST-HST, public service bodies are entities such as municipalities, schools, public college, public hospital, charities, and substantially government-funded nonprofit organizations. The amendment provides these public service bodies with an improved flexibility in claiming their rebate of the GST-HST. It generally allows public service body to claim in a subsequent claim period a rebate of GST-HST paid that has been paid in a previous claim period for a period of up to 2 years. This is a simplification measure because it's less burdensome to claim in a subsequent period a rebate that you may have forgotten in a previous period than the current process, which is to make an amended rebate claim. La dernière modification à cette partie, ça fait des
Final change is of a housekeeping nature, housekeeping amendments, to improve the accuracy and the consistency of the GST and HST application. It doesn't change how GST and HST is applied. The changes are to ensure that the English and French versions, for example, are consistent. It updates some of the terms, which are tax terminology now, and makes any errors, references, that sort of administrative housekeeping improvement. And that is the end of the second section.
Mr. Fergus to start, and we won't be going very long. But Mr. Fergus, who else is once on the list? Mr. Alves, okay.
Il me semble que ça, c'est... Merci beaucoup, Monsieur Mercier.
Thank you, gentlemen, for your presentation. It seems this is not a controversial topic, but I want to make sure that for Quebecers whom you consulted, did they bring up any questions about GST or HST? Or basically GST on supplies of municipal transit services? Well, we consulted twice on these amendments. We held discussions with representatives of transit services after the first consultation. And after the second consultation, we didn't receive any requests for changes. Thank you.
Yes, on introducing clarifications and technical improvements to the GST-HST rules applicable to certain pension plans and financial institutions, what is the net cost to the Treasury of that measure?
These are fairly technical. Certain measure may, I don't think we have an estimate for that because certain measure may close potential loophole while other measure provide a further relief, and overall they likely balance each other.
Could you get back to the committee with some sort of estimate?
I think it's very difficult to make estimate in those kinds of measure because we don't have data to make the estimates.
So
because these are very, very, very technical measures. It's not like if we were relieving a new good or services where basically, you know, we could go to StatCan and evaluate, you know, based on their survey, what is the value of something.
So on Measure D, clarifying the application of GST HST to supplies of municipal transit services to accommodate the modern ways in which services are provided and paid for. Are you aware of what Innisfil is doing with Uber? They've entered into a municipal contract with Uber, the municipality has, to offer certain services. Last year, this government in their BIA decided to add Uber into it. So what is the status of Uber if they are operating as a part of a municipal transit service under this measure?
First of all, they would be for profit, Uber.
Yeah, but it's a municipal transit service. For example, the city of Penticton has a private operator for their municipal transit service.
Municipal transit service is a defined term, and generally what you need to do is you have to be actually offering a service and to be considered a transit service that is dedicated specifically for the purpose of providing municipal transit. If you are just a contracted entity, you may not be actually being the one who is the entity who's doing municipal transit. You may just be the person who is contracted to provide that service.
So are you saying that there are certain types of municipal transit services? Because to me, if a municipality decides to engage with a private contractor to carry out certain functions which is publicly available to all and subsidized by the taxpayers of said area, to me that would be a public system delivered through a private mechanism. So perhaps you may want to look into that, and because again, last year we put, or I should say this government put Uber in the category where they had to pay HST. Then, yeah, I know, I'm very liberal with that.
Well, I don't know the structure of the city you referred to, but in a situation is that if all of the municipal transit basically is paid by the municipality, they pay Uber, including tax, they pay tax on these things, municipalities are entitled to a 100% rebate of the GST, HST they pay.
I will let the people of Innisfil know through their great representative what you've said today.
Federal representative, you mean?
Great federal representative.
Okay. Wanted to be clear on that point. I think we only have one more question left, do we? Ms. O'Connell, and then we will adjourn.
Thank you. I'm following up on the municipal transit as well, but to Mr. Albus's point, I mean, in Durham Region Transit, we would contract out to taxi cabs to provide our accessibility transit. So if there wasn't, if in some areas of the community, it wasn't feasible to send a transit bus, an accessible transit bus. So we have a long-standing contract, and it's on the books under Durham Region Transit for an upset limit of taxis. That is the transit service.
So in your particular case, as my colleague mentioned to you, municipalities are entitled to 100% rebate of the GST they pay. So if they pay for a service and they pay GST, they are allowed to get 100% of it back. How a municipality chooses to sort of structure its fares, the relief has been put in place for municipal transit services. So it's generally characterized what is a municipal transit service. For example, if you personally were to call a taxi cab because you didn't have the availability of municipal transit, that wouldn't be treated like municipal transit. So there were various categories of what is considered municipal transit, and you know that would be a characterization for the CRA to make. What is characterized as what is an eligible municipal transit service.
Right, but it's not the individual who calls the taxi; it's the dispatch of transit.
And again, if they would have paid tax on that service, they'd be entitled to recover it through their GST, PSB municipal rebate.
Okay, then I guess my question really is in and around the wording of this. I'm confused in terms of what it's actually clarifying, that the exemption can apply regardless of whether a supply of municipal transit is made as a supply of a service or a supply of a right to use municipal transit, for example, through the sale of a pass. What is the exemption on this? The sale of the cost of administering the pass, or the because the sale of a pass the individual purchases that? I guess I'm confused by the wording of this. Can you elaborate?
The way the exemption worked before says it was an exemption for a service. And if you look in a traditional way, you would have a service of transit. You would walk in the bus and you would put change, in the machine, and you had directly a service. Most of the way it's done now, it's through ticket passes, like all the Presto cards and those kinds of things. When those cards and those tickets are sold to you, the best legal characterization of that is a supply of a right, not a supply of a service. It was a legal nuance, like that it was actually it's not taxpayer raised it for us, it's CRA that raised it for us, that they say for us to continue to interpret it the way it should be interpreted in terms of what is the policy. They ask us to be more precise and say that it can be a supply of a right or a service.
Thank you.
Okay, with that, thank you, gentlemen. That will conclude part 2, and you'll be back for part 3 on Monday at 3:30. Just for members, the discussion earlier on divisions and parts, if you, as members, could send the parts or divisions you'd like to ask questions about or hear the summary of, send them to the clerk by noon tomorrow. And we'll give those the priority, and then if there's time, we'll hear the summary at the end. So a meeting will be added for Monday from 3:30 to 6:30. With that, meeting adjourned.